Today, we're going to try and cut through some of the jargon and really explore how organizations, well, how they communicate their true value these days.
Yeah, it's definitely moved beyond just the old balance sheet, hasn't it?
Absolutely. We're looking at the full picture, the long-term impact, the future viability of a company. And it raises this really crucial question for all of us, How do we actually know if a business is genuinely sustainable? Not just for next quarter, but, for the long haul.
A fundamental question.
So we've gathered a pretty comprehensive stack of sources, fantastic guide covering reporting, governance, sustainability, and, yes, the really cutting-edge stuff on integrated reporting.
It's a lot to get through, but really important.
Right. And our mission today is to distill the key insights, kind of give you a shortcut to understanding how corporate disclosure has evolved and what really effective modern reporting looks like now.
Because it has changed dramatically.
It really has.
Yeah.
And the hook, I suppose, is that what companies report now goes way beyond profit and loss. It's about their actual footprint on the world, and that impacts your future, whether you're an investor, an employee, or just, a customer.
Exactly. It touches everyone.
Okay, let's unpack this then. Corporate reporting.
Yeah.
It wasn't always this complex, right? Feels like we've come a long way.
Oh, absolutely. If you think back, companies used to be much more, shall we say, opaque. The journey really started with this drive for more accountability, initially focused on shareholders.
Right.
You had the Cadbury report back in '92. That was a landmark, really highlighting the need for proper dialogue between boards and institutional shareholders. And later, UK corporate governance codes, like in 2010 and 2016, just built on that, emphasizing that shared understanding of objectives.
And these institutional investors, we're talking about the big players, aren't we? The pension funds, insurance companies, their influence is huge.
Massive. They manage enormous sums for individuals' pension funds, life assurance, investment trusts. And their dominance grew, which concentrated power. Now, that could be a force for good.
But it also created some knots, didn't it? This complex web you mentioned.
Exactly. That concentration, while bringing expertise, also led to, a complex web of agency relationships. And that brought its own problems.
Such as?
Well, the classic one is fund manager short-termism. Keynes talked about being concerned with market value in 3 months, not long-term worth.
Right. Chasing quick returns.
Precisely. And you often found pension fund trustees who perhaps didn't have deep finance backgrounds and maybe weren't that interested beyond the immediate numbers. Plus, individual shareholders, they typically had almost no direct say.
Yeah, that sounds like a system waiting to be challenged. Which leads us, I suppose, to this shift from just passively holding shares to something much more active. Shareholder activism.
A really vital evolution, yes. It was about moving from just being a trader to being a responsible owner.
So what does that actually look like in practice?
It takes various forms. Using voting rights more strategically, engaging directly with directors, really scrutinizing who's on the board, or even putting forward resolutions at AGMs or EGMs.
And what kind of issues trigger this intervention?
Oh, a whole range. Flawed company strategy, maybe underperforming divisions, questionable takeovers or sales, executive pay packets that seem out of line.
One's a popular one.
Indeed. Also, failures in internal controls, think health and safety issues, big IT failures, poor succession planning, and increasingly social responsibility, environmental concerns.
We saw the devastating result when governance fails, didn't we? I mean, the 2008 financial crash is the obvious, painful example.
A stark reminder, absolutely. The OECD found that crash wiped out something like $5 trillion from private pension funds globally.
Really?
Just imagine.
Wow.
Yeah. UK funds were down about 15%, Ireland's over 30%. It was a huge shock, and it led the OECD to really push for stronger governance, better risk management, urging shareholders to look beyond just tracking an index.
So, if dialogue and transparency are key, how do companies actually share this crucial info with shareholders? What are the main channels?
Well, the foundational mechanisms are the general meetings and, of course, the annual report.
Okay.
General meetings, you've got the annual general meeting, the AGM, which is the main yearly event, voting on reports, accounts, directors, pay, dividends, that sort of thing. Boards are really encouraged now to make it a proper Q&A, a real dialogue.
And the other type?
Extraordinary general meetings, or EGMs. They're called for specific urgent things, maybe a big takeover bid, a rights issue, something that needs shareholder approval quickly. But underpinning all this is the principle of disclosure. Shareholders own the company legally, so they're entitled to enough information to make informed decisions. It's about transparency for good governance. AGM and the annual report are central to that.
And within that reporting, there's what they have to disclose by law, and then there's what they choose to share voluntarily, right? That voluntary part seems to have grown a lot.
It really has. Mandatory stuff includes the core financials, income statement, financial position, cash flow, the auditor's report. In the UK, also the remuneration report and a business review.
Standard financial bits.
Right. But the voluntary disclosures are where it often gets more interesting. Things like detailed risk information, operational reviews that give more context, social and environmental data, maybe expansive CEO statements.
So an annual report started becoming more than just numbers. It began telling a kind of story.
Exactly that. It evolved. You started seeing more narrative chairman CEO statements, the business review trying to use less jargon. Part of this was driven by things like the UK's attempt at an operating and financial review, the OFR, which aimed to cover risk, social, and environmental stuff, though it was later revoked.
But why bother with voluntary disclosure? What's the motivation for companies?
Several reasons, really. It gives a much fuller, more rounded, often forward-looking picture. That helps investors match the company with their own criteria, risk, strategy, ethics. Crucially, it reduces that information gap, that asymmetry between managers running the company and the owners, the shareholders. Less moral hazard, more trust.
Ah, okay.
And frankly, it can attract investment. More transparency can mean lower perceived risk, which can lower the cost of capital. Plus, it helps with compliance, assurance, aligning objectives, and showing accountability to different groups. It reminds me of that quote from the Cadbury report back in '92, something like, "The lifeblood of the markets is information. The more transparent the activities, the more accurately securities will be valued." It's fundamental.
Okay, so this brings us to a bigger question. How does all this change how we define a company's success today? Clearly, it's not just the financial bottom line anymore. We hear the word sustainability all the time.
Exactly. And that's a huge shift,
Yeah.
sustainability.
Well, the classic definition comes from the World Commission on Environment and Development in 1987. Development that meets the needs of the present without compromising the ability of future generations to meet their own needs.
A powerful idea. It is. You can broaden it out to think about achieving the best outcomes for human and natural environments both now and into the indefinite future. It's about continuity, economic, social, environmental, institutional, thinking long-term.
And it's not purely environmental, is it? I've heard it called the triple bottom line.
That's the one. John Elkington's concept, the triple bottom line, or TBL. It forces companies to think about three dimensions: economic, social, and environmental, often summed up as people, planet, profit.
Okay, break that down a bit.
Sure. So the economic perspective acknowledges limits to growth, focuses on genuine long-term planning, avoids things like just boosting the share price short-term through, say, questionable accounting or bribes.
Right, sustainable economics.
Then the social perspective. This is about impact on communities, social justice, are wages fair? Is the workplace safe? No child labor. Does the company support the local community? Think of Cadbury's Bourneville Village historically.
Like people.
And finally, the environmental perspective, maybe the most obvious one. Managing resources effectively for the future, using fewer non-renewables like oil and gas, cutting down harmful emissions like CO2, reducing the overall ecological footprint, replanting timber, that kind of thing.
People, planet, profit. Got it. But how do companies actually measure these broader impacts? Profit is easy to count, but social justice or environmental impact?
That's much harder, you're right. One way is through measuring footprints. The environmental footprint tries to quantify a company's impact, resource use, pollution, harm caused. Is it using resources faster than they can regenerate? That's unsustainable.
Could you give an example?
Sure. Think about making laundry detergent. An environmental footprint assessment would look at reducing chemical use, maybe having fewer factories to cut transport emissions, using cardboard instead of plastic, making packaging lighter. All those things add up.
I see. And the social footprint.
That evaluates sustainability in terms of what's sometimes called anthrocapital, human and social resources. It covers human capital, people's health, skills, knowledge, rights. Social capital, the networks, shared knowledge, like how taxes fund social services. And constructed capital, the physical stuff, infrastructure, tools, roads.
So it's about measuring impact on people and society structures.
Essentially, yes. And there are different ways to measure comparing actual resource use to what's available, or looking at intentions, like whether a company aligns with the UN's development goals.
Okay, measuring is one thing, but then they need to account for it. Right. Integrate it somehow. What does accounting for sustainability actually involve?
Good question. One approach is full cost accounting, or FCA. This tries to calculate the total cost, including those environmental and social costs that companies often didn't pay for directly in the past, what economists call externalities.
Internalizing the externalities.
Exactly. So for a car factory, FCA wouldn't just look at building costs. It would try to factor in the lifetime environmental impact, the pollution from traffic generated by its location, maybe even the cost of disposing of the cars eventually. It's trying to capture the true full cost.
That sounds complex.
It is. Another approach is triple bottom line accounting, which directly ties back to that people, planet, profit idea. It means designing reporting systems that track performance against all three, balancing profit goals with social and environmental ones.
Right, so it's about managing all three actively. But how do companies manage this day to day? Are there specific systems or frameworks they use?
Yes, definitely. There are established management systems to help embed this. Two well-known ones are EMAS, that's the EU's Eco-Management and Audit Scheme, and the ISO 14000 series of standards.
Okay, what do they do?
Both are voluntary schemes designed to help organizations improve environmental performance and support this kind of accounting. EMAS requires a public environmental statement, independent checks, and an environmental management system, often one that meets the ISO 14001 standard.
And ISO 14000.
ISO 14000 is a whole family of standards focused specifically on setting up that internal environmental management system, the EMS. It gives external assurance that a company has good processes in place. Often, getting ISO 14001 certified is a step towards getting EMAS registration.
What are the benefits for a company doing this?
Well, tangible things like reduce waste costs, saving energy and materials, lower distribution costs, but also improved corporate image and, importantly, a framework for continually getting better. These systems often involve social and environmental auditing, assessing the broad impacts, often involving stakeholders, which then feeds data into environmental accounting. That's about integrating these measures into core financial processes to find savings and reduce impact. Think mass balance, carefully tracking inputs versus outputs to minimize waste.
And all this data ends up where?
Ideally, in social and environmental reports, these are often still voluntary, and what's included varies. But typically, environmental sections cover emissions, energy use, water consumption. Social sections might cover human rights, health and safety, training, fair pay, community involvement.
And this is genuinely useful for stakeholders.
Absolutely. It raises awareness of risks, helps ethical investors or consumers make choices, can sometimes preempt stricter regulation, strengthens governance and brand reputation, and fundamentally, shareholders have a right to this information about how the company operates.
And we do see companies embracing this. I think you mentioned Rio Tinto earlier. Even in a tough industry like mining.
That's a great example, yes. A huge mining corporation facing constant scrutiny. They've actively pursued sustainable development, achieved high ratings in sustainability indexes, and set specific targets, like cutting freshwater use by 10% or greenhouse gases by 4%. It shows it can be done, even in challenging sectors.
Okay, this is where it feels like everything starts to come together. All these threads, governance, shareholder dialogue, sustainability, TBL, they seem to be converging now into something called integrated reporting, or IR.
Exactly. IR is the next big evolutionary step. It's not just another report, it's really a different way of thinking about and communicating value.
How so?
The International Integrated Reporting Council, the IIRC, defines it as a concise communication about how an organization's strategy, governance, performance, and prospects, all within its external environment, lead to value creation over the short, medium, and long term.
So connecting all the dots.
Precisely. It forces companies to show the linkages between their strategy, their governance, their financial results, and their social, environmental, and economic context. It's meant to help sustainable decisions and allow investors and others to understand the real performance. Often, it's intended to be the main single report.
So crucially, it's not just sticking the financial report and the sustainability report together in one document. It's more fundamental than that.
Absolutely. That's a common misconception. One of the source examples highlights this. A marketing director thinks it's just a mix, but the finance director points out the real emphasis is on how the different capitals interact.
Capitals.
Yes. IR is built on the idea of integrated thinking. It's about understanding how the company uses and affects various resources and relationships, these capitals, to create value sustainably. It allows a much broader assessment than just looking at financial ratios. Businesses need it to explain their strategy and get funding. Investors need it to see how value is really built over time.
Right. This is the really innovative part I read about the six capitals. Can you quickly outline what those are?
Sure, they represent the key resources and relationships you have. 1. Financial capital, pretty straightforward cash, assets. 2. Manufactured capital, physical things, buildings, machinery, tools. 3. Intellectual capital, intangibles like employee knowledge, patents, brand reputation. 4. Human capital, people's health, skills, motivation, experience. 5. Social and relationship capital, networks, community relationships, shared norms, trust with stakeholders. 6. Natural capital, environmental resources, air, water, land, biodiversity, energy, and the systems that absorb waste. The key insight isn't just listing them, it's understanding how they interconnect and how the business model transforms them to create value or sometimes, unfortunately, deplete them.
A much more holistic view.
Exactly. The purpose of IR is ultimately to improve information quality for investors so capital gets allocated more efficiently. It promotes a cohesive approach to reporting, showing all the factors affecting value. It boosts accountability for this broad base of capitals and really encourages that integrated thinking and decision-making for long-term value creation.
So if a company produces an integrated report, what are the key principles we should look for to see if it's genuinely doing this well?
The IRC framework outlines 7 guiding principles. 1. Strategic focus and future orientation. Does it clearly link to strategy and look ahead? 2. Connectivity of information. Does it show how different elements relate to each other, the dependencies? 3. Stakeholder relationships. Does it show understanding of key stakeholders and how their needs are considered? 4. Materiality. Does it focus on what truly matters for value creation, both good and bad? 5. Conciseness. Is it relevant and to the point, avoiding clutter? 6. Reliability and completeness. Is it balanced, accurate, and includes all material aspects? 7. Consistency and comparability. Is it consistent over time and allows comparison with others where relevant?
That sounds incredibly thorough, but
Yeah.
auditing something like that must be a nightmare compared to just checking financial figures. How do we ensure these reports are credible?
Yeah, that is the big challenge right now. You're right. It's much less clear-cut than auditing financials. The whole concept is still evolving.
What are the main concerns?
Well, a survey from South Africa, where IR is actually mandatory, highlighted some key issues. Do traditional audit teams have the right mix of skills? There's fear about auditor liability because the scope is so much broader, it costs more. There's a lack of agreed-upon criteria for assurance. And sometimes, companies' own systems for tracking non-financial data aren't mature enough yet.
So what's the solution?
Well, there's no easy answer yet. Innovation is definitely needed. The thinking is that assurance will likely become more cost-effective over time as practices develop. For now, maybe the solution is guidelines for assuring specific parts of the integrated report rather than the whole thing at once.
Stepping stone approach.
Perhaps. Longer term, people have suggested alternative models, like having a panel of experts review the report, but that comes with risks. Would it command the same respect as a formal audit? Could it just replace meaningful stakeholder engagement? Very. The consensus seems to be that companies need to focus on refining their integrated reporting and engaging stakeholders first before we make huge changes to the assurance model. It's definitely an area to watch.
What a fascinating journey we've covered today. From those early steps in shareholder dialogue through the rise of sustainability and TBL, all the way to this comprehensive vision of integrated reporting. It really paints a picture of how companies are being pushed and are starting to tell their full value story.
It's a fundamental shift, moving beyond just profit to encompass a much broader definition of value creation and impact.
Absolutely. It's not just about looking good. It feels like a necessary evolution for businesses to be truly resilient and successful in the long term. So the final thought for you, our listeners, as you look at the companies you buy from, invest in, maybe even work for, are they just reporting the numbers? Or are they truly attempting to tell the story of the value they create and the impact they have across all those capitals we talked about, thinking about today and tomorrow? Something to mull over. Thank you for joining us.